Okay, well, welcome to Mrs. Royce's Accounting Lecture Series. This series is going to be the introduction to recording closing entries. What I first want to do is review the accounting cycle. I want you to look at this, and I want you to look at all the steps that we've accomplished so far. We've accomplished quite a bit. Have you ever heard the phrase, when one door closes, another door opens? Well, this applies to accounting too, believe it or not. The phrase relates to accounting that for every accounting period that opens, a previous one has to close. And what that means is, this is one of the steps in the accounting process. Now, I'm going to give props to Rebecca Hill from Study.com because that really made sense to me, that when one door opens, another one closes, it's the same thing for accounting. That really makes sense. Accountants use the phrase, and this is what I've always heard, it's called closing the books. Now, you're wondering what the closing process is. The closing process is the step after the financial statements have been completed, and it prepares the accounts for the recording of transactions in the next accounting period. But still, what does that mean? Well, during an accounting period, we have two types of accounts. Now, we have many classifications of accounts: assets, liabilities, owner's equity, revenue. But during the accounting period, we have two types of accounts. The types are what are called permanent accounts and temporary accounts. Now, this is what a temporary account is. A temporary account is like a temporary tattoo. It is only there for a short period of time. For the accounting fiscal period, a temporary account shows a change in the owner's capital account. So here's the definition. Temporary accounts are used to accumulate information, store and keep information, until that information is transferred to the owner's capital account. That is a temporary account. What's also important is temporary accounts are also referred to as nominal accounts. Now, a permanent account. That sounds just like what it sounds like. It's a permanent account. Again, like a tattoo, it stays there forever. Okay? A permanent account is made up of the accounting equation: assets, liabilities, owner's equity. Those are the permanent accounts. The definition for this: accounts used to accumulate information, again, store information from one fiscal period to the next, are permanent accounts, also referred to as real accounts. This is a really good picture of the classification of temporary and permanent accounts. As you can see, it basically is what accounts are here and what accounts are here. And think about your financial statements for a minute. Exactly. The temporary accounts you'll find on your income statement. Your permanent accounts you will find on your balance sheet. The closing process only applies to temporary accounts. Closing process means you take these accounts and you zero their balance out. You would never do that to a permanent account. Why would you need to close the account? As I just said, close equals brings that account to zero. What do you think would happen to our income statement from fiscal period to fiscal period if those accounts were not zeroed out at the end? How do you think we get these account balances to zero? How do you think we start that process? Perfect. Journal entries. Journal entries are used to prepare temporary accounts for the new fiscal period. Those are called closing entries. And then I hope you noticed that that account that we've been seeing that's been empty, this is where the income summary comes into play. The definition of income summary is a temporary account used to summarize the closing entries for both revenue and expense accounts. And this is the end of this first little quick video. We're going to go into more detail in class, and I'll do another video that actually shows you how to close the accounts. Thanks for listening.